For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, this is Managing Your Financial Future. Thanks so much, me. I love my little intro there. It's fun.
It's fun to. I may need to update it though. I mean, every 100 episodes or so, I think we need to update this thing. At least, yeah. I'm Johnny Dean, your podcast host, and with me, of course, is Professor Rick Plum. I was going to throw in something like, when you're an advisor, it helps to have as much experience as possible. And as everyone knows, Rick Plum is full of it.
Oh, thank you.
See, that would have been stealing a line from the Captain Tuttle eulogy, which we're not going to get into. So anyway, welcome to the podcast. This is an exciting one for me. We've gotten notes from people over the last year or two, as we've talked so much about buckets and the bucket strategy. And we've talked about individual aspects of the bucket strategy. We've talked about what should go in bucket 1, what should go in bucket 2 and 3, how have interest rates affected buckets, why we do buckets, why we like it. But what we've never done, at least that I can recall, or it's been years since we've done, is an actual bucket strategy here on this program. Now, generally we don't do it because the intricacies and the details that go into an actual advisor to client bucket strategy can be hard to follow.
And we don't usually do it because everybody has their own individual set of circumstances. And so everybody's different. Everybody's the same in that they should have a bucket strategy, but every bucket strategy is different because it's tailored to that individual's needs or their individual needs.
Yes.
How much income do they need? When do they need it? How long do they need it? What is their income and makeup? Are we looking at purely just the portfolio, what it can provide, or are we integrating that with your other incomes like Social Security and pensions? How does it fit your specific needs? But the overall idea of buckets, the concept of buckets, is consistent throughout.
It is, and that's why I thought we could do this today. We could take a hypothetical couple and a married couple, because it's helpful to do it with a married couple, and we can work with a little bit more money. And, well, because you have 2 Social Securities, you have potentially a pension, and, I mean, it's a little bit easier to do it this way. And I thought we would give everybody listening just the idea of what you could, in general, expect if you had somebody doing the bucket strategy. And this is the Professor Plum doing this bucket strategy. And you put together, Professor Plum, the numbers and the assumptions on this.
Very quickly, yes.
Yeah. So again, it's a cursory look at a bucket strategy. And we had a nice note from a fellow that actually you and I both knew way back in the day. Right. His name was Nick, or Nicholas if you prefer. And he had gotten the bucket strategy guide, which you can download, by the way, at luciacap.com. If you go in the search bar up top at luciacap.com, type in bucket strategy, there's a free guide you can download that will tell you a lot of this information. Maybe not the specific numbers we're going to give you, but it will give you the idea of the bucket strategy.
It walks you through the concept. It doesn't teach you the math and the strategy to create your own necessarily, but if you're smart enough, you can probably do it.
Well, Nick wrote in and he said, if you want to tell people, because he has the guide, if you really just want to see how the bucket strategy works, take a look at pages 5 and 6 of the bucket strategy guide, and it will tell you by the time you read page 5 and you read page 6, and it's not long, it's 2 pages. By the time you read that, he says, you should have the little aha moment that says, oh, now I get it. I understand how the bucket strategy works. So if you folks want to download the guide and kind of follow along on those pages, you can. We're going to be expanding it a little bit here. But Professor Plum, let's talk now. Let's get into this, because we've only got like 30 minutes or so, and I want to make sure we cover as much as possible. But I thank Nick for writing in and doing this. He did this a couple months ago. And so let's get started on this bucket strategy, Professor. What is the first thing that people need to know about this?
Well, the whole idea is that we're trying to find a way to create a stable income that does not that helps you not worry about what the markets are doing at any given moment? Because as we've seen just this year, let alone the year before 2022 and others, the markets move. They move up and they move down, sometimes unexpectedly. Sometimes we're expecting it, but we just don't know when. We're always expecting a downturn, but then it may go up 10% before it goes down. But there's always movement, and volatility is a way of life whenever you're investing with the market. Volatility is not risk. How you react to that volatility, what you do with that volatility, is where you introduce risk to your portfolio.
Okay.
Risk is the permanent loss of money. Volatility is the up and down movement of value, but it is not necessarily, it is not the permanent loss of money. Selling in a down market is risk. That's the permanent loss of money.
All right.
So we're trying to avoid the risk. We're trying to manage the risk of the market. And the way we do that is we create, in a very basic conceptual way, different time horizons for the money that we're investing. We are identifying the appropriate time horizon to the appropriate investment to the appropriate time horizon. Money I need in a shorter period of time should not have that risk of permanent loss.
Right. And that's why we do this.
Other than me spending it.
Well, that's why we do this strategy. So let's get into some of the numbers here.
So the idea is we break it into bucket number one, which is short-term need, short-term investments.
Money I need over the next
6 to 7 years.
Yeah.
The biggest debate about buckets isn't should you do buckets, but how long should the buckets last, each of the individual buckets. In our world, bucket number one is 5 to 7 years. We want to have enough principal, enough cash in bucket number one to provide the cash flow that I need to spend.
Which, by the
from
way,
my investments.
5 to 7 years is, by the way, the correct time
right.
period.
Typically, we're dealing with 7.
All right.
And we'll get into why 7 and then ultimately the next bucket works in a minute. So we want to put enough money in there to identify. First, we have to identify how much cash flow do I need from the portfolio? How much money do I need and when to be able to spend? And so we look at our cash flow. But we put enough money so that we can withdraw principal and interest. Oh, he said we're spending principal. Yes. In bucket number one, we are going to spend principal and interest, and we're going to draw that bucket down to close to zero over that allotted time frame. What that does, though, is it allows the rest of the portfolio time to grow, time to go through some volatility, time to get a potentially much better rate of return, and time to replenish what we've been spending out of bucket number one.
Beautiful.
Bucket number two. The job of bucket number two is to replenish bucket number one as it gets close to 0, 6, 7 years from now.
We're taking out value averaging for the moment and doing all that.
Right.
Okay, yeah.
And so the idea of bucket number two is I don't need immediate liquidity. It doesn't have to be accessible in a moment. I can deal with, what do they call it? When you take a CD out early. Early
withdrawal penalty.
Yeah, early withdrawal penalties and things of that nature. As long as I know that it's going to go away before I need the money. I can accept a little bit of volatility because I have time for it to recover. It doesn't have to be CDs. It doesn't have to be treasuries and things of that nature. I can get a potentially much better rate of return, but I want to have it available to me at the end of bucket number one, so it's not a pure stock market investment. We know that a pure stock market investment can be down for more than 6 or 7 years. We've seen it happen even in our short lifetimes.
Not as short as they were before, but yeah.
2000 to 2010, the market, if you had done this,
flat,
you wanted more than 7, 8 years for your pure market investments. So we have bucket number two in the middle that replenishes bucket number one and gives us another 7 or 8 years of cash flow distributions. So we've got bucket number one for a 6, 7 year period of time, call it 7. Bucket number two to replenish bucket number one for another 7, 8 year period of time, so that we have 15 years. Why 15? Because we want time on our side. We've had 10-year periods of time where the stock market didn't produce positive results. We have not had a 15-year period of time where the stock market, at least not in the last 30 years or in modern investment, post Great Depression 29 time frames, where it's produced negative results. We want that time horizon because we don't want Murphy's Law to come in and play and say that your sequence of returns, your next 15 years are going to be not the best.
Yeah, we don't want that, and we don't want you to have to try to decide when to retire based on what the market's doing.
But the fact that we've identified time horizons now says we know what investments to use to back up those needs.
All right, good. Well, let's get to this hypothetical situation now then.
Okay, well, the bucket strategy guide deals with taking money from a portfolio. It talks about, that's not necessarily why we don't like the 4% rule. It talks about sequence of returns. Returns are not created equal. It goes into a little bit more detail, but the idea is we're trying to avoid turning volatility into risk, and we're trying to create a stable cash flow. So I took it a little bit further. Instead of just having a flat distribution from the portfolio, which is very common though. If, somebody, both, husband and wife or a single individual, they've already gotten their pension started, they've already started their Social Security, they just need more money from the portfolio, and they have a pretty systematic for the rest of the time. They're, other than inflation, their cash flow is about the same each year. When you have a married couple, maybe they've already turned on their Social Security, so it can be a flat distribution, or maybe one of them is waiting a little while to take their Social Security, maybe at age 70, but they're going to retire a little bit earlier than 70, so they need to take more money from the portfolio in the early years so that they can take less money from it for the rest of their life once they hit age 70.
Imagine that.
And that's the way I played with this one.
Good.
That was the assumption I made.
All right, good. That's an assumption.
A 67-year-old and a 65-year-old.
A 67-year-old spouse and a 65-year-old spouse. Okay.
Right. The 65-year-old has already started their Social Security. They decided to take the lower one, or they're about the same Social Security, early, and then the older one was going to wait until 70 to start theirs. That comes not into play necessarily for their lifetime, although it could if they live a long time, but it comes into play for the survivor issues and some other things. Social Security strategy is a big part of any financial plan that you're going to deal with.
Okay, in this case,
they've already decided their plan.
The 67-year-old is going to wait till age 70.
Right,
the 65-year-old is already taking their Social Security. Okay, good.
And they want $8,000 a month gross income coming in. The 65-year-old's got $30,000 a year, $2,500 a month of Social Security. That's the only income coming in. So the other portion needs to come from the portfolio.
So they need, $5,500 a month that has to come from the portfolio right now as they've retired.
And the reason I set it up this way is because $5,500 a month, multiplied by 12, $66,000 a year, the portfolio is $1 million. Proverbial $1 million portfolio.
It's just easier math.
You can do this with 100,000. You can do it with 10 million. You can do it with 100 million. It still works.
Forget it.
Just move the decimal. But the idea is, if you look at it and you read about it and say, well, that's a 6.6% distribution. That distribution's too high. That's not right. You can't do that.
It's higher than 4%, Professor Plum.
Right, that's breaking the 4% rule.
I heard you could only have 4%, but you're taking 6.6% out, and these folks are 67 and 65 years old.
Right, and I'm doing it on purpose. Thank you very much. And the reason I'm doing it is because one of them has not started their Social Security yet. And in 3 years, when they turn 70, they will start their Social Security.
And how much will that Social Security be at age 70? You said the first one is $2,500.
It was $38,000 a year.
$38,000 a year.
So combined, once they both turn on their income,
their Social Security.
Their Social Securities. Their combined income from Social Security is $68,000 a year.
$68,000. Now they need $80,000 a year.
No, they need $96,000 a year. They need $8,000 a month.
Oh, I'm sorry. They need $96,000 a year. Okay. So they're still a little short.
So in the first couple of years, we're taking $66,000 out. And then the fourth year, we're only taking $28,000 out because we're getting so much more from Social Security.
Yeah.
And then every once in a while, we bump it up for some inflation. Now, one thing I've ignored is inflation on the Social Security, the cost of living adjustment on Social Security. Yeah, it's 2.5% for next year. But you never know exactly what it's going to be.
Right.
You also don't know how much of that COLA you're actually going to keep because Medicare, we don't know what Medicare,
all
all
right,
that kind of stuff.
But this keeps it on a generic level.
If your Social Security goes up more than zero, hey, you just have more money. Oh, shame. So we can always make it work. But the whole idea is we're going to backfill this. What we've done is we've laid out how much cash flow we need, and then where that cash flow is going to come from.
Okay.
First 3 years, $30,000 of cash flow is coming from Social Security. 66 cash flow is coming from the portfolio. The next 4 years of bucket number one, $68,000 is coming from the Social Security.
Because now they're both taking their Social Security.
You know,
Yeah.
28,000 is coming from the portfolio.
And that's a considerable that's considerably less than 6% at this point.
At that point. But with cost of living and other things.
No, I understand. Sure. Okay.
So what we want to do is we want to put $300,000 into bucket number one. And assuming it only earns 2.5%. Now, right now, I think we can earn significantly better. You can get a high yield money market account, 4 or 5%, 4%.
Well, but we don't know.
But I don't know what it'll be 4 years from now, 5 years from now. But I think 2.5 is a reasonable bet on bucket number one, safe investments.
Okay, so of their million, you've decided based on their income needs to take a $300,000 chunk and put that into bucket number one.
Bucket number one. And we're going to draw that down at 66, 66, 66, and then 28, 28, 28, 28, 28 over the next 7 years. And at that level, we're not going to have much left at all. Probably very little.
In bucket one.
In bucket number one. But that's only of that 300,000.
Okay.
Now, the second bucket, we need to have X amount of dollars coming out. So we're going to put $250,000 into bucket number one.
So you've put $300 in bucket number one. You've put $250,000 now into bucket number two. You've taken almost half of their portfolio.
Taken more than half.
I'm sorry, more than half of their portfolio, and put it into something other than stocks.
Now, bucket number two is probably the hardest investment conceptual bucket going. Bucket number one is very straightforward, safe.
Yeah.
We've got that. Bucket number three, the long-term growth bucket's fairly straightforward too. Growth, stocks, things of that nature, reinvested all the way. Bucket number two is kind of a quasi because it depends very much on the individual, where you are in the market, how you feel about things. In the traditional sense, it's more of a balanced portfolio of stock and bond. This is where the typical 60-40, 50-50 stock bond portfolio actually fits. It does well. But depending upon the conservative or aggressive nature of the individual, there's other investments you can use there. If you're very conservative, maybe you use an index annuity or index CD. If you're a little more aggressive or you want to do something a little bit different, there are equity-linked index CDs that are structured notes. I'm thinking structured notes that have a little bit of downside protection, but better upside. I mean, there's lots of things that can happen there.
Potentially, but this depends on the person's risk tolerance.
But we're assuming you can get about a 4.5% rate of return or better out of an investment that you just sit and leave alone for 6 to 7 years.
All right. So while they're spending,
I think you can do better, but we're going to plan. Not guaranteed. I'm not saying this is guaranteed, but you always plan on the lesser return because it's real easy to understand what happens with more.
Sure, of course.
More is when you think of X and you get less than X, and so we try to be somewhat conservative.
Okay, so just to keep people caught up, the $300,000 they're going to spend bucket number one down
pretty much to zero.
Right. If we did it this way, for the first 7 years, but during that 7 years, you got $250,000 sitting in bucket number two, not taking anything out of that, but letting it go through. You said you are predicting or planning on about a 4.5% annual rate of return. Is that right?
Annualized rate of return, compounded over time. So if you put $300,000 or the $250 into bucket number two, and you leave it alone, and it grows at 4.5%, you could probably get that guaranteed right now, given today's rates. But that's what I said. It depends on what you want to do.
Of course.
That over 7 years grows to $340,000.
340. So when bucket number one has been spent down to almost nothing 7 years from now, you've got $340,000 in bucket two,
ready to replenish bucket number one. Now, bucket number one originally was only $300,000.
Yes. But you have more.
But now I have more because I want to have a little bit longer distribution, and I want to get some extra money out of it for inflation.
Yes, we don't know what inflation will be, but it's nice to figure that in there. So are you going to take this
I'm
now?
I'm going to take that and turn it into a bucket number one type investment. If it was a balanced fund, I'm taking it out of the balanced fund and putting it into T-bills, laddered bonds.
Everything that was in the bucket one before.
Typical bucket number one. Yeah. And when I do that depends a little bit on what kind of investment I'm using.
Sure.
If I put a fixed annuity for 4.5%, I'm not doing it till the last minute. If I'm using a balanced portfolio, I'm going to use it when opportunistic. But what that does is, if I put $300 in bucket number one, $250 in bucket number two, that's $550 out of my million. That leaves me $450,000 that I don't expect to need for at least 15 years.
And the reason is because you've been spending bucket number one for the first 7 years. You've taken the next 8 years, something like that.
And this one was 8 years.
Okay, the next 8 years, and now you're spending you're getting a little bit more.
I'm getting the equivalent of a 2.5% annualized inflation.
Right. Okay. And you're now going to spend that over the next 8 years. So you've taken care of, for the first 15 years,
Right. So now
they're in their cash flow needs.
Right. And so that means that I can take the remaining $450,000 and invest it for growth. And even if you are Murphy's Law incarnate and the 450 turns into 350 the next week, because you manipulate the markets that way. When you invest, it goes down.
It happens. It happens.
It just feels like that.
Yeah.
You have, in this example, 14 years, 52 or 51 weeks left to let it grow. So it takes away the risk of having to sell when the market's down, because I know I don't need it. I've got the ability that if the market goes against me, I've got time for it to recover, like it did in 2022. Like it did in September of 2020, the first week of September of this year.
Professor, this addresses the psychological part of people's strategy, because generally, and I think for the most part, if people have the income, the cash flow that they need
and they
to
know
live
it's
off
not
of,
in jeopardy,
and it's not in jeopardy, they honestly, in most cases, could care less what's going on in the stock market portion of their portfolio.
it's an interesting discussion point, but it is not something to immediately react to. And if what we've found also is that when the markets go down and somebody is properly bucketized, the question isn't, oh my gosh, it's 2009, the market's down 40%. I got to get out. And no, it's, are we near the bottom? Should I be investing? Should I be? I mean, I had 15 years. I've lived a year or two, so I've still got 13 years of money. Maybe I take some of that long term or that midterm money and go put it back into the market. And go. Those are all discussions on taking opportunistic moves, not I'm afraid of the world coming to an end. I've got to, and this is where the 4% rule, the strategic rebalancing of a portfolio, the systematic withdrawal of a portfolio falls short. It's not just the bad sequence of returns that goes against it. It's the emotional impact and because the emotional reactions that we have tend to be one of the biggest detriments to a portfolio, and people do the wrong thing at the wrong time for the wrong reason unless they have a reason not to do it. And having a bucket strategy keeps you from doing the wrong thing, or helps you stop from doing the wrong thing.
People's biggest fears, from most of the surveys that I've seen in retirement, are running out of money before you run out of time. And when we say running out of money, what we really mean is that money is not there when you need to spend it. And that is their fear. But if that money is always coming in no matter what, through certain guaranteed sources, then honestly, that fear goes away. And that's what makes this so powerful.
So we put the $450,000 into a pure growth account. Now, what can we assume a 15-year portfolio can grow at? Not a guaranteed rate of return, but let's say it grows at 8%. Just, throwing it out there. The historical average is more in the 9 to 10% range. Well, let's say we only get 8%. After 15 years, the portfolio, the bucket number 3 portfolio went from $450,000 to $1,427,000. So I've got $1,427,000. So basically, I started with $1 million, portioned out bucket 1 and 2, had bucket number 3 investing, gave myself my cash flow that I needed over that 15-year period of time. I gave myself a pretty healthy cash flow for that period of time,
with a bump for a raise for inflation in it,
right, and also a reduction because I knew that I was going to get some Social Security in there.
So if this portfolio earned 8%, this bucket 3, $450,000 over the course of 15 years, that $450,000 left alone, if we never touched it, Professor Plum, and
overall,
again, we're leaving out value averaging, you wind up with
roughly $1,440,000.
That 450 turned in into $1.4 million.
So start with $1 million. We took in this example, we took $678,000 in cash distributions out of the portfolio. And using 2.5% in bucket number 1, 4.5% for the first 7 years in bucket 2, 2.5%. Now, obviously, when we turn it back into a bucket number 1 later on, using a hypothetical 8% rate of return on our growth portfolio, we end up with $1,440,000.
And this is after you've spent down now in this example. Buckets 1 is gone, and now your bucket 2 that refilled bucket 1, that's now gone.
Too.
But you turn to bucket 3 and you say, look what I've got after 15 years.
Right.
I've got $1.4 million now.
And now this couple is hypothetical. 80-year-old and 82-year-old couple has $1,440,000. And if we inflation adjust it and do all the things and do no inflation on the Social Security, the distribution that they're expected to take in the next year is about 5% of the overall portfolio.
How much is that?
Well, the overall gross income is $140,000.
Wow. 140,000. Now, of course, it's 15 years later. They
Right.
started with 96,000. They are now 82.
Yeah.
Now they've got, they can take up to 140. What'd you say?
Well, this is set up to take 140.
Sure, I understand, and that's fine. That's fine.
But they're 80 years old. If I want to break the 4% rule at 80 years old, I'm all for it.
Go ahead.
I don't need to necessarily provide a 30-year time horizon for 80 years old.
Probably not.
And that's what the 4% supposed rule was designed around, a 30-year time horizon plus inflation. So, I mean, but this all lays out the foundation of what is going on, when it's going on, and how to make sure it works. I mean, that's just the whole idea.
Well, okay, yeah. So
now, you talked about it earlier, saying we want to have bucket number one, we want to have sources to control the emotional aspect of this. We want to have sources from guaranteed sources.
Because I don't want to be worried.
I don't want to be worried. And so there are ways to make this even more guaranteed. And there are products out there that guarantee income. And so maybe they say, you know what, even when the Social Security kicks in at $5,500 total between the two of us.
At age 70.
A little over
one's age 70, one's age 68.
In 3 years, even at that point, it'd be nice to have a little bit more flat out guarantees. Maybe we want $600 to $6,500 a month, guaranteed, that can never go down. Social Security, not going to go down. It's not going to go down in a couple of years. It's not going to.
Yeah.
And the portfolio, I want to build in a little bit more. So there are these protected income sources where we can basically buy guaranteed income, and they are great for helping us from an emotional standpoint. Going back to, I know I got the money coming from Social Security. I know I've got another $800-900 a month coming that, regardless of what the market does, regardless of what the world does, I know that's guaranteed for as long as either one of us and a married couple live. We're going to be fine.
Yep.
So you can create these protected income. It's an optional bucket, so to speak. So the core 3 buckets work for everybody. Some people want more guaranteed income, more protected income, to help them with that emotional,
I understand. Sure. Yeah. Some do, some don't. But okay, if
we
you
can
do,
add that in, and that takes some of the pressure off of the portfolio over time, because we know we don't need as much money.
Where do you see pressure on the portfolio in this bucket strategy you just laid out? I mean, to me, the way it's set up, 1, 2, and 3 is fairly certain.
Well,
but
I set it up
where
that
do
way.
you see that?
In this particular one, I'm not too worried about the pressure. But if you're the larger the cash flow from the portfolio compared to the overall income, the more pressure you feel, even if it's only in that 4 or 5% range. You just feel more pressure. It's not necessarily that it's there, but it is emotionally there. So if instead of having $66,000 of Social Security coming in, even if they had $1.5 million portfolio, but they only had $30,000 of Social Security, the biggest percentage of the income is coming from the portfolio. And if all you have is $2,500 a month from Social Security, but your fixed wake up in the morning expenses are
much higher,
$3,500, $4,000 a month.
Yeah.
Having some extra protected income just sits really well with a lot of people.
Well, it really does. And so that's always an option that you can have. Now, after 15 years, your portfolio, your bucket 3 has $1 million for something,
yes.
right? You don't have, so now you got to take that $1.4 million and rebucketize that. Is that correct?
That is correct. So at some point, you're going to be looking to, this is where you mentioned it. We're not going to talk about value averaging, but it's part of the world. Value averaging is looking for opportunities to reset your buckets. And you reset them when the world is favorable to you. Now, we've set this up so that if you have a bad 15 years, you'll be able to recover. But that's only if it crashes the first year. What if it doesn't crash the first year? What if we have a 20% return the first year? We expected 8. What if we have 2 or 3 years in a row where it's 20%? What 2019, 2020, 2021, 21%, 28%, 29, 30%. Let's take, at that point, our bucket number 3, we expected 8 or 9. Even if you expected 10, you're significantly ahead of the game there. This is where you should be scraping some off the top. Take some or all of the excess return over and above what you expected and reset your buckets. Reset your time horizon. Refill bucket number 1. And so now you go back to a 15-year period of time.
You just buy yourself more time.
Buy yourself more time.
There. Give yourself another year or two.
By taking advantage of the volatility. We are trying to protect. We're trying to keep risk to a minimum by protecting against the volatility, but it doesn't mean that volatility is always bad. Let's take advantage of good volatility. Are you a good volatility or a bad volatility?
The reality is, Professor Plum, as we set up this bucket where you spent bucket 1 down all the way to basically 0, and then you spent bucket 2, which became bucket 1, again all the way down to 0. The reality, though, is that along those 15 years, you're more than likely, if you do this the way
there's going to be good and bad
the
times.
Bucket strategy, you are going to be taking some out of bucket 3 and refilling. I mean, that's generally how it's done on an ongoing basis.
That's the way of life.
Right.
The problem is we just don't know when.
No, but what you've done, Professor Plum, is given yourself, and this example really shows it, how you can buy yourself 15 years of income, cash flow. I know that for the next 15 years, I'm 65. I know that until I reach age 80,
my cash flow is good.
I've got cash flow. I don't care if the market tanks by 50%. Now, personally,
this is the basic. We always have to provide for emergencies and other things, and unexpected. Because hey, life happens. Sometimes it happens in a good way. We also didn't talk about, like this person's mortgage may be paid off in 10 years, and so their income goes down. There may be an inheritance out there, but we don't want to count on that. Well, there's all kinds of things that could happen,
and there may be
good and bad,
and there may be health expenses that come up.
Right, but that's part of the risk management side of it, where you have proper insurance and other things.
And this is all part of a strategy, an overall strategy.
This is just the investment philosophy.
Yes,
there's so much more that goes into overall planning for life.
This has been a great discussion, and I really wanted to, because we don't have visuals to show. Usually when we're doing this kind of thing, we show actual buckets, and it's easier to see. So I hope you folks, obviously just listening to this show, could follow along. If not, certainly go back and listen again. But Professor, I think you did a great job explaining this, keeping this as simple as possible.
This is my first time.
Yeah, right. Your first time today.
No.
Oh, it's the second time today.
No.
All right. Well, whatever. It's just one of your first 5 shots at explaining buckets today. I mentioned before that if you want to get the overall view of this and need some more information about how buckets, I'm going to say not buckets, the bucket strategy. I've seen things called the bucket strategy, a bucket strategy out there. Believe me, it is not the bucket strategy. There's way Professor Plum just described.
There's a very popular one out there with a big company, and they have bucket number 1 at 2 years.
That's just not going to work.
The market goes down and can stay down. I mean, if you look back at 2007 to 2009, it took almost 2 years just to find the bottom, let alone recover.
No, it's not going to work.
We want time to recover.
This is the bucket strategy that you folks just heard, and this is one of the privileges of being able to listen to this podcast, because you got it. You can go to luciacap.com, LUCIACAP.com. I mentioned this at the start of this episode. Go to the search bar up top and just type in bucket strategy, and the first thing that comes up on that list should be the guide, and you can download this guide. It's called The Bucket Strategy, Tailored Financial Strategy for Your Retirement. If you want to follow along, and if you just want to read the first 3, 4, 5, 6 pages, Nick, who emailed us, says he got it by page 6. You read it, you download it, and you should be able to, if you haven't understood the concept to this point, this should get you to say, I get it, at least I get the concept. And what I hope this particular episode has done for people listening is given you a little bit more meat to it, in the sense that we've put actual numbers in, and we've gotten this from the professor, who's explaining why we're doing certain things, why they set this up the way they do, and why you're making certain assumptions that you are.
Right. And in the guide, page 5 and 6, go through the 3 bucket, 4 bucket, 5 bucket conceptual plan, and then the rest of it goes into more of, why do we even do it this way? What are the problems with doing it the other way? And there are problems with doing it the other way.
As we have said on many other podcast episodes, and if you want to go back and listen to those, maybe next week, I don't know about next week, but maybe in the next couple of weeks, we talk about some of the problems with doing it the wrong way. I don't know. I'm
the biggest one is you run short of money.
You run out of money. And how does that happen?
Or it emotionally affects your retirement in the fact that you wanted to do X, but now you don't feel that you can.
I read something not too long ago about the 60-40, where you have a 60-40 portfolio, and then as you go from age 65 to 75 and so on, you gradually reduce the amount of exposure to stocks because it's supposedly safer. And I have heard people start to say now that kind of thing is dead.
Oh, good.
And so they're starting to understand it. Maybe we'll get into that. If not next week, we'll do this in another time, because I like to say what we're going to do next week. I may change my mind between
got
now
a
and
week.
then. Right. So this is not a tease, but it will be coming up at some point. Folks,
by definition, what we've done in the way we're spending the safe money first, we're increasing the overall percentage
by default.
Because if I'm spending my safe money, leaving alone the growth money, by default, if that growth money does grow, it's a bigger percent because A, it grew faster, and B, I spent the other stuff.
Professor, the way you described it, if you did it this way,
you almost got 100% equities 15 years from now.
And you're 80 years old or 82 or whatever it is.
But I do like the value averaging concept.
Of course. So that's we just did this as an illustration, and I hope it helped. If you want to get in touch with Professor or any of the Lucia Capital Group advisors, 800-644-1150. 800-644-1150. Give them a call. Professor Plum or any of the Lucia Capital Group advisors. Did I say Professor Plum, certified financial planner professional?
And
accredited wealth management advisor.
Without a crib sheet. You did well, Johnny.
I did. I'm in studio with you today, and I don't have my crib sheet. My crib sheet's back in Indiana. Anyway.
Yes, you just did. That was the first one.
Okay, good. I should have said that. You are a certified financial planner professional, which also helps. But I did mention experience, and experience counts for this kind of thing. You can talk to Professor Plum or any of the Lucia Capital Group advisors, because Professor Plum is the one who oversees every single bucket strategy plan that goes out. You are the Chief Financial Planning Officer at Lucia Capital Group, and that carries some weight, too.
Unfortunately, I carry too much weight, too.
I was letting you say that. I threw you the line. You took it. 800-644-1150, 800-644-1150. Subscribe to this podcast. If you hadn't subscribed or you didn't know about this podcast, you never would have known about this episode. You never would have heard this information. It would have been lost forever. So please, subscribe to this podcast. Tell your friends. This is the kind of information you get on every single episode. Apple Podcasts, Spotify, and you can find us online as well at luciacap.com. That's all for me. Anything else from you?
No, not exactly.
We're about out of time, so I just wanted to throw that out. Thank you, Professor Plum. I'll let you get back to teaching more about buckets, because I know you got a lot going on today. I appreciate that. Again, if you folks want to get in touch with us, go to luciacap.com. Let us know if you have any ideas that you'd like us to throw around, something you'd like us to talk about. Just email us there at luciacap.com. For Professor Rick Plum, our certified financial planner professional, I'm your podcast host, Johnny Dean. Thanks for listening. Talk to you again next week. This has been Managing Your Financial Future.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. A value averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities, you must consider your willingness to continue purchasing during periods of high or low price levels. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. Market-linked CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. There may be a penalty for taking withdrawal prior to maturity, which also may cancel out earned interest. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risks, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Fixed indexed annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims paying ability of the issuer, subject to their terms and conditions. Withdrawals prior to age 59.5 may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Structured notes, equity indexed annuities are considered complex investment products. They contain unique features, risks, terms, conditions, fees, charges, and expenses. Product suitability must be independently determined for each individual investor. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial Financial Advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.